right, thanks. I hope you guys didn't get tired of me because I'm back now for another 50 minutes or so, so I'll try to keep it light. This should be a really exciting panel. Tokenization is definitely one of the buzzwords around crypto these days. I know for anyone that was at the event last night, I think 80% of the conversations I was in talked about tokenization. So let's get into it. But first, I just want to give each of the panelists maybe 30 seconds to talk about what they do and maybe just describe like one project, one effort at tokenization that you're involved in. So Adonis, would you like to go first?
You're second. Yeah, awesome.
Yeah, so hi everyone, my name is Adonis. I'm a product manager at State Street, based out of Zurich, but I work quite a bit out of London as well. I am actually in charge of the digital custody platform, meaning that, as you know, State Street is the second largest custody provider out there, mostly for traditional finance right now. And we are building kind of a segue into the digital assets world by building this digital custody platform.
It's mute.
Is it on now? Yeah, perfect. Hi everyone, my name is Barbara. Pleasure to be here. I work at DWS. DWS is a large German asset manager with around 860 billion in AUM across all major asset classes, including crypto soon, hopefully tokenized assets at some point as well. I'm responsible for our digital products. Digital assets is one of our focus topics. We're looking at 3 different use cases in particular. One is building a crypto ETC platform in Switzerland. The other one is stablecoins. We believe there's a strong market need for a European-based, trusted and MiCA-regulated stablecoin. And then the third topic is tokenization, a very strategic topic for us. And here in particular, we're looking at fund tokenization.
Well, hi everyone, my name is Andres. I'm responsible of the digital assets unit in BBVA Asset Management and Global Wealth, and which means that I'm responsible for leading and coordinating the initiatives through this ecosystem across the world where BBVA Asset Management is operating, not just focusing in Europe, just also in Latin America, Turkey, and the rest of the world.
Thank you for having me here. My name is Christoph. I'm at Union Investment. As of now, I run trading business at Union. Going forward, I will be one of the guys in charge of our strategic definition of tokenization and digital assets. We are on this topic for at least 4 or 5 years, having had a number of POCs, especially in the digital bond area and also in the derivative space.
Hi everyone, my name is Diego Miyasu. I'm partner account executive at Settlement. What I do basically is support companies across industries in the way they adopt blockchain, from strategic advisory, ideation to solution development and maintenance. We do that through 2 ways. One is support with all of those processes, and also we developed a set of tools that makes it much easier and faster for companies to build all the founding blocks they need for their blockchain use cases. For tokenization, the idea is to help our customers build their own tokenization engine so they can actually own their solution.
So Diego, let's stay with you. I imagine probably most people in the audience know what tokenization is, but I just want to make sure that everyone does, so that you all stay with us for the next 45 minutes. So could you just quickly give a definition of tokenization and explain all the different permutations within crypto, just the different buckets that it might fall into?
All right. So we can start very simply by saying that tokenization is very basically representing the ownership of an asset on blockchain. So those assets can be any different class of assets. So actually, when we talk about tokenization, we'll differentiate all the different tokenization use cases depending on the asset class. So tokenizing real estate will not be the same as tokenizing bonds or gold, for instance. So what we try to do at Settlement is discuss with our customers with specific business lines and identify the types of assets they're interested in tokenizing, understand the reasons why they want to tokenize it, if there is something to be improved in the existing process, if it's an asset that is illiquid, if there are high barriers to entry, like real estate, for instance, and then define all the technical blocks that you need in order to make this tokenization happen.
Right, and tokenization, I mean, it spans a wide spectrum of crypto, everything from stable coins like Tether down to tokenizing gold and bills of lading and financial instruments, kind of known as real-world assets. And I know we're going to get into all this on the panel. And Barbara, maybe going to you, what would you say are the biggest benefits to tokenization?
It's a good question, Stephen, and I think one that is asked again and again and should be asked again and again, because we're not trying to apply the technology for the sake of the technology, but to realize some benefits, right? I think in the answer you really have to differentiate per asset type and then also potentially per jurisdiction and the regulatory and specifics of the location. We at DWS, we are in particular looking at fund tokenization, given that these are the assets that we issue. For fund tokenization, I think you can cluster the benefits into 3 different categories. And that's A, operational efficiencies, B, distribution benefits, and then C, the most exciting one probably, additional functionalities, something that stems from the inherent properties of the blockchain technology. I think often the first category, the operational benefits, are discussed, right? Faster settlement, increased transparency, maybe a change in the value chain, maybe some disintermediation of certain players. I think here important is that there's many preconditions, many trigger points that need to be reached in order to realize these benefits. So if that's your short-term pitch to realize these efficiency gains, I think it will be very difficult to be successful. So I think this is really a long-term game, right? Where we live in a tokenized vision, tokenized future vision where, you know, assets and funds and money and everything is tokenized. Then, yes, I totally believe in these operational benefits, but short-term it's more difficult. I think the other 2 categories is something maybe where short-term benefits can be more easily realized. And that's the second category, where distribution benefits. So what if we tokenize a fund and now we distribute them to traditional retail and institutional clients? What if we now can reach wallet-based investors, right? It's just a new investor group for us, and that would be a very, very nice benefit for us to realize. And then the third one is very interesting as well, new functionalities. So for example, there's some asset managers that they're tokenizing money market funds to use them as payment products, and asset managers normally don't issue payment products, right? So these are new benefits where we can think about, are there inherent properties of the technology that enable us to realize new use cases?
Okay. Adonis, I'm curious, the State Street perspective. I mean, one of the largest, biggest custody banks in the world, and you're building a bespoke platform for tokenization. What is the thought process there?
Thank you. So the huge advantage we've been having at State Street is that we basically already do everything that we would be doing with a digital custody platform. We already do that in the traditional world. So we've been custodying for X hundred years. And the reason why we've been doing this push into the DCP world, in the digital custody world, is simply because we've been clients have been reaching out to us, and we've been driving this internally as well, as in we already cover basically a lot of these things that the funds are looking for. So we do fund accounting, we do taxes, so it was only a matter of time for us to basically take on the last legal block right there, which is the key management system. So a client might have an ETC fund, or they might have basically some Bitcoin laying around, or it might even be tokenized assets. And they already do maybe FAA with us, so they do fund accounting, and now they want us to basically hold their keys for them, because they just don't have the capacity for that, and they don't have the knowledge for that. So it was just basically a very logic step for us to move up the value chain from the low value add services such as FAA, taxing, and all of that, to basically holding the keys for the customers as well.
Andreas, this might be the most important question in the entire panel, so no pressure. But tokenization is not necessarily a new concept. I mean, it's been around for 7-8 years at this point. I mean, going back to 2015, 2016, when companies were kicking around the idea of privatized digital ledgers to take advantage of blockchains without necessarily having to use open protocols. But regardless, there's been lots of pilots, there's been lots of POCs, but we still haven't seen that one big mainstream use case that's been adopted at scale. I'm interested in your thoughts as to why and why this time it might be different.
Okay, maybe we can discuss off topic after the panel if 7 years is so long time to take enough in the financial industry. But assuming that is true, I think that there are at least 3 keys in order to understand why it's taking so long. The first one is all the noise, all the buzz and controversial that was surrounding the DeFi and the digital assets industry in the last years, triggered by probably the Terra Luna collapse, and then other episodes such as the Three Arrows Capital and FTX, or something like that. The second point, from my point of view, is the regulatory issue. We saw that the European Union members are making a lot of efforts in order to establish the boundaries of the playing game with MiCA, and even it should be not a one-shot regulation and should be updated in the future in order to make the scope bigger. The thing here, or the challenge here, is to establish the boundaries, as I said, of the field game where financial institutions will feel comfortable playing with or playing in. And the third one is that if we are looking for the business case and if we are looking for mass adoption in the blockchain technology or using the blockchain technology, there is a special ingredient that is the mass. And if there is one thing that the institutional and the traditional finance system has, is mass. Because in our case, in BBVA Asset Management, for example, we have approximately 80 billion of assets under management in Europe. And that's the most challenging thing, trying to transfer that off-chain assets under management to the on-chain system, because, as Barbara said, we saw clearly operations benefits in order to optimize our processes. But the path from today to have fully on-chain optimized processes in our industry will take probably double-digit period in order to make
and I can appreciate that. Diego, would you like to weigh in?
Maybe jumping in. Sharing a bit of my experience also dealing with banks across countries in Europe. I think the slow adoption also is kind of due to an approach towards blockchain adoption where basically at this moment blockchain adoption within banks is driven by blockchain enthusiasts within banks. So people that are given budget within innovation teams to try stuff with blockchain. That's great. At this stage, when they launch something and try something out, this is the only fact of using blockchain is considered to be a success. But now I think it's about time to actually adopt the technology and achieve convincing business leaders that blockchain creates value. And for that, the question is not what can I tokenize, is why would I tokenize? So you wouldn't have the right answer for any class of asset, because it makes more sense to start tokenizing some assets rather than others, because for some of those assets you have some real life challenges. So what we try to do at Settlement when we have this type of discussion is try not to show a catalog of use cases, a catalog of possibilities, but start the discussion around what the business people around the table have and identify as a challenge. So we take one example, real estate, for example. What are the challenges we see in the real estate market? An important challenge I see is high barriers to entry. In order to access the real estate market, you need to have a very high minimum investment. That means, me personally, I cannot access this market. I would love to have a tokenization solution that fractionalize real estate assets, so I can jump in that market. You know. So it's the kind of approach and methodologies that I think would accelerate blockchain adoption.
And I want to get into the different asset classes. Adonis, I know you wanted to weigh in, but Christoph, do you want to weigh in on this quickly as well?
Steven, I would like to jump in on this topic. Do we have a slow adoption or not? I would kind of disagree. When looking at previous innovations in the web space, Web 1, when the internet was invented, it took a couple of years before there was really mass adoption. You've had a number of issues in terms of connectivity. It was slow. Then the pipes broke down. You lost connection, and also when we're looking at Web 2 with the platform strategies kicking in. When Amazon initially announced that they will sell books online, everyone said, I have a bookshop here around the corner. I never ever will purchase books online, or even clothes. No one really could imagine to purchase clothes online. Google, Facebook, exactly the same. Google, there was initially the question about what is in the business model, how can they monetize, exactly the same with Facebook. So therefore, I think we are absolutely on the right track right now with POCs. As a kid, when you want to learn swimming, you don't buy a book reading about how to learn swimming, but you just do it in practice. And I think that's what we realize, what we see with the POCs. And looking at one area, I guess, which is quite prominently represented in digitalization of assets, digital bonds. We've seen this year and previous year, we've seen a number of issuances, and I guess it's a kind of hockey stick evolution. As it was said here, we have regulation now in place. We see investors gaining trust with blockchain technology. You have regulators also being ahead of the curve on this topic. So I wouldn't be surprised to see really benchmark issuances coming in the next 1 or 2 years.
Great.
Thank you. I'll add a last comment on that as well, is that because colleagues have made very good points around regulation as well as the use case identification. Another point I'd like to raise more from a product manager perspective is that, well, whoever has already done enterprise-grade transition in an IT context at a large bank knows how complex that is. Sometimes that can take up more than a decade. And so basically, it's a fair question to ask, of course, but you have to keep in mind that the tech rails we have a lot of technical debt, a lot of legacy debt. And so to get that moving, because the point is not just to slap a blockchain on top of the existing tech stack and make it even more complex. You're trying to reduce complexity, enhance efficiency. And so for that, you're basically finding the right spot to plug in the blockchain. And that just needs time to get all the teams rolling, all the different applications integrated as well. So it's a huge technical debt that takes years and years to leverage and to figure out what to move and where to move it.
We can help you with that, actually.
If I guess just a quick note to what Diego said. I think that sometimes we are looking for the biggest business case, and we are trying to find it understanding the blockchain as a goal and not as a technology or as the tool in order to first make more efficient our processes and then offering our clients crypto native or digital native products that will be attractive for them. I think that it should be clear that blockchain technology should be used as a tool and not as a goal instead.
Got it. No, thanks for that. I know this was a question that I know we talked about a lot in the pre-meetings, and it is fair to wonder, like, what is an appropriate amount of time to see progress, because the internet has taken decades to grow, and I mean, you guys are all in the financial industry. I used to work for a bank too, and I understand how hard it is sometimes to root out billions of dollars in legacy tech for something new. One of the areas where I see challenges in wide adoption of tokenization is moving from a POC to a pilot to production, because orders of magnitude in difficulty, technologically, organizationally, bureaucratically, going from those stages. I'd like someone to just quickly, for one, briefly define POC, pilot POC for the audience, because they're not the same thing, even though I know they're used interchangeably a lot, and just go over the difficulties in moving from those stages. Barbara, would you like to go?
Sure. So I think pilot, I think there's different definitions, as you say. Yeah. I think pilot for us is an internal exercise, POC is then external, and then a scalable use case, as the name says, right? It's scalable. I think generally for asset managers, because we manage fiduciary money, right? We don't manage our own money, but the 860 billion that we manage is client money. It's always difficult to do POCs, right? Client money is, should be protected, and we need to discuss them with the client if they're interested in that POC as well. It cannot just be for our benefit, but it needs to be for the benefit of the client. I think and that links very well to what you said before, what the POCs are helpful for is pushing fragmented parts of the value chain, because the asset management and overall financial industry value chain is quite fragmented across different market players, the POCs are pushing different market players to start adopting, right? Because if we want to invest into a tokenized bond, we cannot decide that on our own, right? We need someone to issue the bond, a bank needs to be involved, a custodian needs to be involved, the fund accountant needs to account for it, our trading system needs to allow for it, right? There's so many different parts, and these POCs are really pushing these service providers to start. And there's some intrinsic motivation on their side, but of course, if the client comes and asks them, to really start adopting, then that's the helpful part, right? And then I think we need to move over, finding a bridge solution, a one-off solution where maybe, a State Street, where our custodian find a one-off solution to custody something to us, to actually build the rails to scale that then, right? So what State Street and other custodians are doing, so that we can not only one-off invest into a digital bond, but in all future tokenized issuances. And I think this is what, linking to what has been overall said in the panel, what's happening at the moment. It's very much this infrastructure that is being built for tokenization across different parts of the value chain that really needs to happen. And sometimes that might look slow. Hopefully in retrospective, if we look back in 5 years and 10 years, we say this is exactly what needed to happen for us to be able to adopt.
I want to get a couple more perspectives. Christoph, would you like to go next?
Yeah, when I want to add, from our perspective, when getting involved in POCs, the key question is what's in it for a client. We, as an asset management firm, we have a fiduciary role we play for our investors, and clearly we wouldn't implement new technology just because of the sake, because we believe it's sexy technology. We not implementing for the sake of technology itself. There has to be a clear benefit for the end investor. So that's for us really most essential. And when looking at most recent POCs. Beginning of this year, we purchased a tokenized Siemens bond. Point number one, we've had a quicker settlement, meaning less risk. Typically, when having new issuances, you have a T+5, you have a T+7 settlement, meaning you purchase a bond, and the transfer of the bond itself and the exchange of money happens 5 to 7 days later. When talking about bonds on chain, I'm sure in a couple of years' time we will get to a stage where we have atomic settlement, T0 settlement. With the Siemens bond, it was a T+2. Additionally, Barbara was alluding to the fact that it's also about having smoother processes. Intermediaries were taken out of the system, which made it cheaper for Siemens, and a part of the benefit they passed on in form of a higher yield to us as an investor. So that's, as mentioned, really essential for us. What's in it for the client, and not just implementing technology for the sake of technology.
Andres, quickly, I just want to get kind of a big bank perspective on this too, from some of the projects that you've worked on. What have been the challenges that, or not necessarily challenges, but what have you learned moving across stages?
Sorry, I didn't hear you.
I'm sorry. What have you learned moving from between pilots and POCs and so on and so forth at BBVA?
Well, what we learned is that blockchain is possible. There is a possibility to go with blockchain. That's the first learning. The second learning is about how we optimize our processes. But I want to say, first of all, that POCs and pilots we need pilots and POCs in order to, we don't have a comprehensive regulatory framework. It's a new World One, MICA. So we need this kind of pilots, because in our top of mind as traditional financial institution and very regulated institutions, we have in our top of mind our fiduciary duty with our clients. So we can go with a production, with something to produce, to go something to market with a new technology if we don't test it before. And I think that the pilot is, as Barbara said, are very important, and POCs also. Okay. So the learnings are, there are possibilities. Probably we have to go step by step, and as Christoph said, and I agree with him, we are in the right track. And coming back to your question, that is taking off, is less than too much taking off, because we have to go first pilot, then proof of concepts, and then go into production. And 7 years probably is not so long time.
Fair enough. I want to ask Diego, you started talking a little bit about what types of assets make the most sense to tokenize, because there's a wide range, like tokenizing dollars and euros to gold to real estate. I'm interested, like, if you can go a little deeper and explain what assets make the most sense, and to what extent does the current economic climate impact any of that? I get, especially Diego, what you're saying, that we're talking about like 5 and 10 year periods probably, but at least like right now, especially when we're looking at like illiquid investments or money market fund and this heightened interest rate environment and sort of bizarro world of financial economics, like what assets make the most sense?
Maybe my answer will disappoint you. But actually, I shouldn't be the one answering that question, because I'm not a business expert, meaning that I work across industries. Obviously, right now there's a big focus on financial institution. What I bring to the table is the technical expertise, how to bring that blockchain-related ideas to life, how to handle the whole project lifecycle. And the idea would be to get that answer from those business leaders. So when I sit down with a bank, talking with different business lines, I will have experts of their own fields. And these will be the people that would be able to confirm or share the challenges that they have, so that we can say, okay, you have this specific challenge, blockchain can bring a solution to that. I thought your comment on the Siemens bond tokenization was really interesting, because the result here, reducing risk and settlement time, that's actually business leader language. Because these people, they don't care about blockchain, and they shouldn't care about blockchain. Blockchain is a means to achieve something. And here the purpose of the POC, I guess, was to convince those business people that blockchain has a true impact that can be measured, that can be linked to a concrete business value. And this is what we aim to. And the way I try to see things is that when we explore projects, when we explore opportunities with banks, is to gather the right people around the table so that everybody pitches in with their own expertise and their own say, because I'm not the one who's going to give a hands-on perfect solution for asset managers or for real estate brokers, etc., etc.
Barbara, I know you want to weigh in here.
Yeah. So I'll also disappoint you. I don't know, but I think
You wanted to weigh in to disappoint me?
yeah. Okay. But it's the central and the critical question, right? And I think many of us don't know yet, right? Because if someone would know, we would see further adoption. There's only really one use case for tokenization that has scaled so far, and that's stablecoins, right? There's a considerable, I don't know, what is it, 120 billion US dollar market cap or something?
Yeah, something like that. I think
Considerable,
Tether
right?
itself is $84 billion.
Consider a market cap, right? And why has that use case worked? Because there's a clear use case for stablecoins, right? Stablecoins are used for multiple different use cases, but it's mainly for trading on centralized exchanges, right? Trading, I don't know, Bitcoin against USDT or USDC, for example, and then for DeFi use cases. And that's, I think, what we have to do for other asset classes. We have to go through them and really look at what are some of the pain points. So you mentioned before real estate, that one of the pain points is limited liquidity in real estate, right? I mean, there are some solutions. For example, we have retail funds that are available for retail investors to invest also very small amounts. I can send you an offer for real estate products. But for real estate, I don't see why blockchain technology would necessarily help us to increase fractionalization. I don't think really this is the pain point today, right? It's again and again cited. I don't think anyone has really...
Again, I'm not a real estate expert, so
me neither.
It was some kind of guess that I had
Yeah.
when I'm discussing with real estate experts within banks, and I say, okay, I have a look at this asset class. I see there are high barriers to entry.
Yeah.
Blockchain can provide a solution. Maybe it's not the perfect solution, and let's assess together if blockchain actually is the right solution, because they will be the ones answering that question, not me.
Yeah, yeah.
But maybe just, for example, the alternative investments, private equity, make it fractionable in order to make secondary markets in order to redeem part of the investment and make it easily, will be a good pain point because you can make an attractive product if you provide with liquidity something that is illiquid due to the fractionability.
I'll be the devil's advocate here a bit. So
I love devil's advocates. Go ahead.
the alternative fund tokenization use case that we've seen in the market, I think it's great effort, and I really applaud the companies that have done it. But what they've done is they've used feeder funds, which is a construct that very well exists in the traditional world, and just tokenized them. And through these feeder funds, they were able to reduce the minimum investments from, I don't know, fictional numbers, right? From 100K to 10K, right? So really broadening it up to more investors that were then able to invest into that asset class. But really, you could have done that in the traditional way, right? So the question really is, again, asking what's, and I'm a big fan of tokenization, right? I'm not trying to say this doesn't make sense, but we really have to see not tokenize for the sake of it, and it sometimes feels with these POCs, but really think about what are the inherent properties, and there's so beautiful properties about blockchain technologies, and how can we leverage that, right? And I think that's kind of the critical question. I don't have the answer for it, but I think everyone is looking for it.
Yeah, I think we're trying to figure that out. Adonis, I know you wanted to weigh in, right? And then Christoph, I'll come to you quickly as well.
So I'll just maybe 2 seconds, I'll spend 2 seconds on the pilot part prior to answering this question as well, because I can get to it from a product development perspective. Is the huge difference I see between pilots, POCs, and prod is obviously in a pilot case, you really need to make your case, your analytical case for why exactly you're a pilot, especially in big banks where you have many pilots that are competing against each other. You need to make a case, like, what are you bringing? Are you increasing top line, bottom line? You need to make a case for that. And then if it moves on to POC, that's where you need to get the other people in the bank involved. So you need to get risk involved. You need to get AML involved so that they can chime in prior to you basically asking for a prod go live. And the POC part is also most often the part where you get contacted by other banks or other consortiums to basically be included in that. And that's where you need to weigh out, does it make sense for me? And that's not so much a P&L question. It's more about if you're left out of that consortium, what impact does it have for your future as well? So that is to answer the POC, prod, and well, to the prod part, well, that's the most complex part, obviously, especially from a regulatory perspective. That's where most people are stuck. So that's basically for the first part of the question. The second part of the question, for tokenization, there is the large dichotomy that we see is between private and public markets. And so for you need to differentiate between are you adding efficiency or utility, or maybe both in the best case scenario. And the private markets, you're most often really adding utility, as has been rightfully said, simply because you're basically widening the investor range. It can go from only pension funds down to family offices, and then private banks, high net worth individuals, and then you go basically down that pipeline, and you can reach customers with a more modest net worth, so to say. So there you're probably mostly adding utility. As for public markets, as Barbara said, it's mostly about efficiency, really. It's about operational costs that you're reducing. So that's the large dichotomy that we see. It's mostly private versus public right now.
Christoph, go ahead.
Yeah, but then it's about cost, Adonis, which will be passed on partially also to our investors, lower cost. So looking at products where we got involved so far in terms of tokenization, I mentioned in the introduction, bonds for me is really a key theme. We've seen a number of high-scale issuers like European Investment Bank. 2 days ago, World Bank, they came with a 100 million euro bond issuance in a tokenized format where we invested in Siemens as first big corporate beginning of this year. So there I believe we will see a significant acceleration, or we are also in discussions with a number of issuers about projects which will be launched quite soon. Then in the derivatives world, it's about OTC derivatives, which from our perspective can easily be tokenized by making use of smart contracts. From next year onwards, tokenized shares will be allowed to be issued. So that's in the kind of traditional asset space. And what I would like to highlight, tokenization is not just a stupid copy-paste from the global document world into a tokenized world. A token, as Barbara was highlighting before, can deliver significantly more when it comes to reporting, when it comes to golden sources of data, which is key. So a token is a highly sophisticated format of what we know today as a wrapper. And then going forward, I'm also a big believer that the investable universe will expand significantly. So I'm not talking about vintage cars or paintings which will become tokenized. I think that's for us as a large asset manager not really a business case. But what you were mentioning with real estate, I'm sure we will see a number of projects in the next year where real estate will be tokenized and also made fungible and so tradable in secondary markets. So that's for me really the next big step where really the juice is coming in from an investor's perspective. We can offer products going forward where retail investors can't find access to right now. And fractionalization of these tokens in combination with what we see as democratization of investing going forward will be a key topic. So retail, from our point of view, due to the expansion of investable universe, will be one of the big beneficiaries.
That's one of the big. Sorry, Diego. I'll come to you in a second.
I would like to say to what Adonis say about the private markets, and I think that we have to drive carefully what our clients will expect from the tokenization in private markets. Because if you ask ultra high net worth individual or ultra high net worth investor or affluent investor, probably they expect to pay a prime to go through those markets because of the fractionability and the democratization of the access to those markets. But if you ask to an institutional, maybe a small size like family office or something like that, they will expect a reduction of the access because of you are making the market more efficient. So they will expect cheaper opportunities. So maybe we have to expect different things if we talk from the perspective of an individual, from the perspective of an institutional.
No, I appreciate that. So one of the big debates that we've kind of covered here is just like what types of assets make the most sense to tokenize, what are the use cases, and I think we had a really nice discussion. A big point of demarcation too that we haven't touched on yet is the public versus private sort of debate. Like there are some projects, especially ones related to big banks, that don't necessarily want to touch tokenization initiatives on top of public blockchains like Ethereum, and then there's others that do. Diego, maybe just because like you're kind of like in the factory on this, what do you see as the pros and cons for each approach?
I'm going to take the example of a project that we're carrying out with a partner that is present here, with a company that I will not name, where we're exploring the benefits of hybrid architectures. So far, tokenization has been mostly delivered on private networks, meaning that the tokens circulate on a closed IT environment, making the benefits of blockchain kind of fade, because if your token is not able to circulate outside of the initial environment, blockchain doesn't make a lot of sense. But we still find some benefits in using those private blockchains. So what we're trying to do, for instance, is, as a pilot, see how we can create tokenization platforms, so trading platforms, where primary market is mostly handled by a private network, and then seeing how we can enable those tokens to circulate on a public ledger, mostly to search for new liquidity sources. Because when we mention the benefits of tokenization, one of the words that come the most is access to new liquidity sources. If you're using a private blockchain, it's going to be very difficult for you to access those new liquidity sources. So the idea is to see how we can enable those tokens to circulate within a very controlled environment, but also enable circulation in public environments by setting up rules within the smart contracts to say, for example, we can whitelist the addresses that are allowed to trade those tokens, and maybe enable the token to go from one tokenization platform to another. So we can actually reach that liquidity objective. Of course, here the main concern is around regulation, because the whole you have to take into account the whole KYC requirements, tax requirements, etc. So There's still some thought to be put in that process, but yeah, I think we believe at Settlement and with our customers that the future is hybrid, future is ZK, and enabling access to those public environments.
Great. Barbara, I know you want to weigh in.
So I think the critical keyword here really is network effects, right? Any blockchain, be it private or public, it needs to garner sufficient adoption, right? And network effects we know from Web 2 with large Web 2 platforms like Facebook can be very, very powerful once they kick in. And I think the issue is, we've seen, I think, in the history of tokenization, these cycles, right? It was private first, then there was a such period of public, then private again. At the moment, there's some high-profile public issuances like the Siemens bond that Christoph mentioned before. I think so I personally am a big fan of public blockchains. I think the big argument for public blockchains is that they already experience network effects, right? An Ethereum blockchain already has a considerable market cap, already has a significant degree of decentralization, a significant developer community, a significant amount of certain standardization for smart contracts, of dApps that are running on the platform. So I think that's one of the key arguments for a public blockchain. Of course, you can build a private blockchain based on these standards of that public blockchain. But I think, that's really the network effects. Getting that critical point might be easier with public blockchains, and then we can really, even more so than with private blockchains, profit from the network effects. Of course, with public blockchains, there's unique challenges. There's regulatory challenges, as you mentioned, right? There's security challenges, like what's with data privacy issues, for example. But I think that's the question, right? Can we solve these issues? But completely agree with your assessment. It will be a multi-chain world, and depending on the use case, there's probably the distinct advantages and distinct disadvantages of public and private blockchains and different public and private blockchains. We'll try to have to combine them and just then look at the interoperability issue.
Christoph, I know you want to weigh in here, but I kind of want to build on that discussion a little bit too, because I think if there's one thing that's clear about tokenization, is that there's not going to be one-size-fits-all approach. Even if it's public or private, I mean, there's going to be different permutations regardless. And then if we then throw in central banks around the world kicking the tires on CBDCs and trying to find ways that those can be integrated into these systems alongside tokenized commercial deposits and all these different systems. So Christoph, my question to you is really kind of like, where do you draw the line first between public and private? And then like two, what thought has been given to trying to find a way to make all these different systems find a way to communicate with each other so that all these different tokenization projects don't, even if as they become mature in their own silos?
So on the discussion public versus private, regulators are nowadays focusing on permissioned versus permissionless. So when talking about regulators, about the setup of the blockchain, that's currently the big debate. And from a regulatory perspective, permissioned blockchains are the favorable ones right now because of the validation process of the individual blocks. You can control who's validating these blocks, based on permissionless blockchains, what you can't do. However, we see in the market various setups. So one EIB bond was on a public Ethereum blockchain. Another one was on a private blockchain network set up by Goldman's. So US is very strict about the topic permissioned blockchain. And most recent transactions we've had, they again were on public chain on Polygon. So that's to this topic. At the end, I believe public blockchains deliver more benefits than disadvantages, as Barbara was describing, and that's what we believe where the journey will go to. Looking at how to connect all the dots, so at the moment, I guess we are somewhere at kilometer 5 or 10 of the marathon. So it definitely will be a longer journey. At the moment, the focus is on the issuance process. What clearly is required, that we have a functioning secondary market activity going forward, meaning all the bonds, all the equities, all the tokenized fund shares, how can they made tradable on exchange. So this, from my perspective, will be the next big challenge. And with the DLT pilot regime, which was kicking in the EU 27 back in March this year, I think we will see a number of offerings coming quite soon. And then the next big topic will be not only asset on chain, but also cash on chain. Barbara, she mentioned stablecoin. We are with the ECB and with German Bundesbank in in-depth discussions about experiments with a central bank digital currency, with a digital euro. And when talking about a digital euro, we shouldn't mix it up with a digital euro for retail, but we in asset management, in the finance industry, we are talking about a wholesale CBDC, which will be clearly be required to have all the synergies then between assets on chain and cash on chain and make it a functionable ecosystem.
Great. Adonis, I want to give you a chance to weigh in here, and then Andres, you a final comment, and then I want to leave a minute or two for questions. So go ahead.
Thank you, Steve. So, well, it's a very interesting debate, public versus private, that we've been having internally at State Street as well. I can give you one example. I mean, I have very competent risk colleagues. And so when we were implementing public blockchains, one of the big questions that came up is, you're sending money to either a validator or a miner, be it on Bitcoin or on Ethereum. Can you identify who that is? And if you can't, we have an issue. Because you're sending money to someone that could be a sanctioned party out in Iran or North Korea. So that is some of the blocking points that we're facing when it comes to public blockchains, basically. Though I do agree that my personal opinion is that they hold a lot more advantages because the network effect is already constructed, basically. So you have the decentralization, you have the network effect, as I said. So that is basically for the first part. But thus the current lack of regulatory clarity around that leads to a very funny situation, which is that ultimately the huge selling point for blockchains was like, we're all on different databases, let's all get onto the same one and reap the benefits of that. Now the funny thing is that more and more institutions are going to private blockchains, and the issue we're seeing is that they're all basically siloed in their own consortiums. So you have one consortium where you might have bank A, B, C, then you have another consortium there on a different blockchain, and you have 4 banks there, then you have 6 other banks on another consortium. And so we're getting back into that siloed mode that we were trying to avoid, but this time in a blockchain world. So thankfully, the good thing is that the public blockchain market has already identified that problem and is already trying to solution for it. I'm thinking about some of the networks such as Cosmos or others such as the subnets that Polygon has launched, but also Avalanche, which are basically playing the hub of a blockchain where you could have multiple private networks on the same hub so that you don't have the risks of interoperability based on the bridges, because as we all know, that's where the most risk currently lies.
I agree with all of you. I think that I'm a supporter of public network also, but I think that this dilemma is part of the game, and I mean probably we need to go first private in order to start our journey and then go public, because in my opinion, private networks are good to test and public networks are good to trade. And what I mean, this have no sense, a private network, if you have short positions and long positions with a big spread between them, because they are not crossing. The bid and ask will not cross. You are only going to optimize your process, but the operations will not be factible in that kind of networks if you don't feed that network with a lot of volume, and probably the volume will come through public networks.
Mm-hmm. Great. I think we have time for 1 or 2 questions if anyone in the audience has. Down here at the front. Then we're going to bring you a microphone.
Hello, thank you everyone for your speeches. It was quite interesting and full of insights that I will bring back to my teams. And I wanted to focus on the operational cost efficiency that blockchain solutions provide for hedge funds, especially on the back-end side. We've all seen that the velocity of the transactions is quite amazing. And in this regard, you mentioned how POC, then pilots, then production is the way to go. But have you then tried the sandboxes, and how is your experience with them, with it? We as a custody solution, we have done that, and we've seen that even so, we find acceptable your period of time from 3 to 7 years until we find the solution for the final customer. Even so, as with the tokenization of hedge funds, tokenization of participation of a fund. The question is, how in the translation of this cost for the final customer, would the operational efficiency offset and the liquidity that brings blockchain with the tokenized world be enough to justify this translation to the end customer? I mean, sorry for the long question, but you mentioned that the final customer doesn't see the benefit. It is just backend and operational cost. But since there's more liquidity, since there's more markets that will create itself and secondary markets, would that be enough justification for the final customer to see the benefit in blockchain, but without seeing the blockchain itself? And thank you.
That's really a good question. I think at the end, the customer won't realize whether transactions are done with making use of blockchain technology or not. It's even when you take your smartphone today, you have a number of apps already being based on blockchain technology. Do you realize it's blockchain? As an end user, clear answer is no. And that's also my expectation going forward. The end user will benefit from a more user-friendly approach, from more efficient processes, from higher yields because intermediaries are taken out. But at the end user won't see that it's due to blockchain. Coming to your topic on secondary markets, I believe for an interim period you will have underlyings tradable in the traditional format and also going forward on DLT platforms. I don't want to go too much into the technicalities, but I guess what's clearly a requirement is that you have one identifier for this security, regardless whether it's traditional format or tokenized format, because this guarantees fungibility of both types of assets and switch and arbitrage from one to the other format.
Great.
And that's it's a bit of a technicality, but it's a key requirement to have not a parallel market for tokenized products, but a connected market for traditional and for tokenized ones.
Thank you for your question. We are at time, so we have to cut this off. I'm sorry, sir, but I think everyone's going to be here probably for at least today and probably tomorrow. So anyone else that has questions, you'll be able to find us. Thank you to our panelists. Thank you for attending. Enjoy the rest of the event.